If you're thinking about investing in real estate, this might be the most important video you watch all year. I've been investing in real estate for more than a decade now, and the reason why real estate is such a powerful wealth building tool is because number one, it's tech and AI proof. You can have as much technology as you want, but people still need a roof over their heads. Number two is you can create a new stream of cash flow that's pretty much passive, because when you have a property, your tenants will be paying you every single month, and if you do it properly, you'll have a manager doing all the day-to-day work, and the profits will go into your bank account every single month. Number three is you own a hard asset, something that you can see, something you can feel, something you can touch. When you own a property, you own the bricks, you own the windows, you own the land, versus when you buy a stock, you just have a piece of paper that says you own a piece of ownership in a company. Number four are tax breaks. As a licensed attorney who's not your attorney, what I can tell you is that real estate has some of the biggest and best tax breaks that a tax court has to offer, but I'll talk more about that in just a minute. And number five is real estate has been time tested. We've seen this decade after decade, century after century, that real estate investors have been able to build wealth, grow their wealth, and compound their wealth through generations. But here's the harsh reality that most people on the internet will never tell you. Real estate investing is hard. It's gonna take a lot of time, especially in the beginning, in order for it to become passive, because you have to learn the game, you have to learn how to make context. Number three, it's gonna take money. Yes, it is hard. I know a lot of people love selling no money down real estate, but let me tell you something. No money down real estate has made me so much money because a lot of people buy real estate with no money down, no credit, and no idea what they're doing, that they then go into foreclosure, and then the bank sells that property at a discounted price to somebody like me. So yes, you want to have money. Do not do the no money down stuff. It's too risky, especially when you're just getting started. And number four is you will screw up. Every single real estate investor has at least one nightmare deal. Trust me, I have been there. It is very stressful. It's going to cost you money, but once you get through that, you'll have years worth of real estate education condensed into that one nightmare deal, and it'll set you up to do much bigger and more profitable deals later on. You're still watching this video, which means you're committed. If you stick with it as a real estate investor, it can change your financial future. But in order for that to happen, there are three things that you need to understand that I'm going to go over in this video. Number one is how do you find a good location to actually invest your money? Number two is how do you build a good real estate team to make it as passive for you as possible and also be profitable? And number three, understanding the numbers. That way you can actually find a profitable deal. So let's go through this in order, starting with number one, the location. Years ago, I was looking at buying a rental property in the city that was divided by a highway. So the circle is where the city is. And I saw that properties in this part of the city were significantly cheaper than this part of the city. So when I was running the numbers, it made it seem like this was where I should be investing my money. But as I started to dig a little bit deeper, what I started to see is all the new businesses were coming in here, not here. Over here was a lot of vacancies. Here it was businesses coming soon. Here was new developments coming in. Here was new construction. Here was more kind of dead. And so I decided to pay a little bit extra to buy a property over here. And I'm glad I did, because over the years what I saw happen is here property values went down, rental rates went down, demand went down, and vacancy went up. Here, demand went up, prices went up, rental rates went up, and vacancy went down because people wanted to move where businesses were. And this is a key concept. Your success in real estate is going to depend on location. Every real estate investor will tell you location, location, location. And the reason why this is so important is you can change everything about a property. You can change the window, you can change the paint, you can change the landscaping, but the one thing you cannot change is the location. And so when you think about where you are investing your money, you don't want to think about where the money is today. You want to think, where's the money going to be 10 years from now? And the way you can start thinking about this is to look, where is the business moving, where is the money moving, and where are the people moving to? And the best and simplest way to do this, I'm going to save you thousands of dollars here, is to do the $5 coffee test. What you do is you walk into a couple of the local coffee shops in the area, and you get a cup of coffee or tea, and you ask the barista, do you live in this neighborhood? If yes, do you like it here? If no, why not? And they will start telling you if they like this area. Either they're gonna say, yes, I live here and I absolutely love it, or they're gonna say, yes, I live here and I wanna get out because the crime is bad, because it's becoming very dangerous, Or they're gonna say, no, I don't live here, but I really want to because all of my friends are moving here and there's so much cool stuff happening. Or no, I don't live here and I don't want to live here because it's a very horrible place to live. Go to a few different coffee shops and start asking people. Because if you wanted to get this information from somewhere else, you're gonna pay thousands, if not tens of thousands of dollars in research to get access to this level of data that you can get by yourself by just walking around and talking to the people working there. And the reason why this is so important and so valuable is because in real estate, insider trading is 100% legal. You heard me correctly. It is legal in real estate. It's illegal in the stock market. In real estate, if you know that a big development is coming here before it hits the media, you can start buying properties there before it hits the press and everybody else starts buying. I'm telling you this from personal experience because another city that I was looking at buying a property, and this time it was a multifamily apartment complex. There was this big vacant plot of land plus some vacant buildings on top of it that was sitting there for a long time, and I was in contract to buy a building that was near this vacant area, but it was really a big eyesore, and I wasn't sure if I wanted to buy this property or not because this whole vacant area really made it look very ugly. So I went into the city hall and I asked them, what are the plans for this area? Are there any plans? And what they told me is Walmart had just signed a new contract to open up a super center in this area. It had not become public information yet. And this is something that they were going to be planning to do in the next 2 years because they had to do all this development and all this stuff. And so that gave me that green light to say, oh, there's more money coming here because if Walmart is going to invest millions of dollars into this area, other businesses are going to follow as well. And that's exactly what happened. So you want to pay attention to the location. How do you do that? Start by number one, doing the $5 coffee test. Talk to people in the area, walk the streets, and see what does it look like to you. Number two, go to the city hall. Ask them, are there any new developments coming into the area, and see what's going on because they want people to invest in their cities normally. And the third thing that I want you to pay attention to as an investor is the population growth or decline in the city / neighborhood that you're looking to invest in. Now, a few years ago, this used to be difficult information to access and you'd have to generally pay money to access this level of information. But nowadays, thanks to Google, it's super easy. Just go into Google and search population of Manhattan or whatever city that you want, and it will show you a trend line of the population of your city or neighborhood that you're looking to invest in. What I look for me personally, and I don't recommend what I do to anybody else, but what I look for is at the very least a stable population, but ideally a growing population. The reason why I like growing population areas is because there's a limited amount of land. And if there's more people moving in with a limited supply of land, that increase in demand generally pushes property values up and also rental values up, which is good for me as the investor because I'm thinking about the next 10 years, not what happened in the last 10 years. So that's why I want to pay attention to the population as well. So when you put this all together, what do I like to look for? Number one is I want to walk the streets, talk to people, do the coffee test to see if people actually like the area, talk to the people there. Don't just talk to one person, talk to a few people. Actually do some work. Number two, go to the city hall, ask them about developments coming near your property because you can be in the same city, but a different part of the city will see all the growth and the other area will not. So you want to pay attention to exactly where you're buying because the neighborhood, the streets do matter. And number three, pay attention to the population because ideally you want an area where the population is growing because if the population is shrinking, there's less demand for people to buy or rent your property. Now that you understand how to find a good location, let's go deeper into how do you build a good team to make your property passive and also profitable. Now, I do want to remind you, for those of you that are investors or want to become investors, my team at Briefs Media publishes a free daily newsletter called Market Briefs, where we break down what's happening in things like the housing market, the stock market, the global economy, our own economy, and the crypto markets into a fun, witty, and easy to read newsletter. We have hundreds of thousands of investors that are reading Market Briefs every morning. Plus, when you join Market Briefs, you'll also get our investing masterclass free as a bonus just for joining Market Briefs. So if you want to get Market Briefs and our investing masterclass, all you have to do is click the link down in the description below to join. Real estate is very much a people game because you have to assemble the right team to make it a profitable deal and a passive deal for you. And I'm going to focus in on 5 team members, starting with number 1, your property manager. This is the person that's actually going to manage the day-to-day stuff to make this deal actually profitable for you. So the way it works for me is when I find a good property and I get it ready, I'll hand over the keys to the property manager. That way they can find a tenant, they can make sure the tenant pays, they can make sure the bills are paid, and they can make sure I get paid because I don't know who my tenants are. My tenants don't know who I am, and I'm not involved in the day-to-day stuff because I don't want to get a phone call when the toilet breaks or something else goes wrong in the property. So for me, having a property manager is extremely important because I don't want to be the manager of the property. I don't want to be somebody who's getting those phone calls when things go wrong. I want to be an investor who spends my time trying to find more deals, not trying to actually just manage the deals because I can hire somebody else to do that. Now, a property manager is going to cost you somewhere in the ballpark of 7 to 12% of gross rent. Sometimes less, sometimes more, depending on what your property manager does and how many units that you have. This, for me, is well worth it. Some people make the argument, well, that's just money you're giving away to them. And you're right, you are paying them for a service. But what you have to remember is if you are doing the management yourself, you have to value your own time as well. And so either you're going to be paying somebody else to do this, or you have to value your own time and pay yourself to do that as well. And I'd rather pay somebody else. That way I can focus my time on building my business and investing in more real estate. The second person you need to have is a property inspector. This is somebody who's going to walk through the property with you before you actually close to make sure you know exactly what you're going to buy. And the reason why I'm such an advocate for you to get a property inspector as well is because there was one deal that I purchased a property without an inspection. And that was my nightmare property. That was the deal that ended up biting me in the butt because I bought this house on the recommendation of one of my contractors. The contractor told me that if I bought this house, we'll be able to make a lot of money because it doesn't need that much work. And the part that I didn't realize was my contractor was so insistent on me buying this property because he was in need of cash. So it was a way for me to write the contractor a check. Well, after I bought the property, not only did the contractor run away with the money, but I also found out that this property was completely destroyed and needed so much work. I made a video covering this on YouTube. It was still, to date, the only deal that I have lost money on. It was my nightmare property. It was a third deal that I did. I have a video where I went over it on YouTube. I'm not going to go too deep into it in this video, but if you want to watch that video, I'll link it for you down in the description. But what I want you to understand is when you enter into a contract to buy a property, whether it's a multifamily, whether it's a commercial building, whether it's a single family property, you're going to have a contingency period. You want to have a contingency period where you can do your inspections on the property to make sure that the property is not about to implode. And you want to have an expert here on your side to walk through the property and give you a report of all the things wrong in the property. That way you don't buy the property and then get hit with a flood of financial requests. The third person you need on your team is a good contractor. Now, this contractor, you want to be licensed and insured. And the reason why I say this is because I used to work with the unlicensed and the uninsured contractors. And these were cheap people. They would come in and do the work for a bargain price. And that was fine for a while until things started to go wrong. And as you start to grow, and as you start to have more deals, well, now your mistakes start to get amplified. And I'm telling you this because there's a saying in the real estate world which goes, if you haven't been sued yet, you haven't been in business long enough. When you get sued, because that will eventually happen if you're in business, you want to make sure you have the documentation to show that you did your work right. And it can help when you have a licensed and insured contractor that can prove that they're doing the work right. And when you work with an unlicensed and uninsured contractor, you don't have the protection when things go wrong with the city, because you want to make sure that you have somebody that can actually make sure they're doing the work right, because if you do it wrong, you're gonna have to pay to undo the work and then do the work again. I'm telling you this from experience because I had worked with many unlicensed and uninsured contractors, and then I had to pay money to undo their work and then redo their work again and again and again. And now I work with licensed and insured contractors. You don't have to work with the most expensive people. Hear me carefully. You want to find a nice middle ground. You don't want the cheapest person. You do not want the most expensive person. But there's this nice middle ground of people that are extremely hardworking at a fair price that will get the job done quickly. Those are the people that you want to work for, and it's going to require you to talk to a lot of people and fire a lot of people until you can find a good contractor. Number 4, you have to have a good accountant that can specialize in real estate investments. And again, I'm speaking from experience here because I've worked with good accountants and I worked with bad accountants. And I had a bad accountant before who was cheap. And when I say cheap, I mean the annual fee that my accountant cost me was very low relative to what I'm paying now. And what ended up happening was I got a call from my accountant one year in January, calls me when I'm in the office, And he says, hey, Jaspreet, how are you doing? I need you to do me a favor and send $15,000 or $18,000 to the Michigan state government by the end of the day today, and then send an additional $100,000 to the IRS by the end of the day today. And you're also going to have to pay penalties and fines on top of this as well, because we made a little miscalculation on your taxes. True story. I went on to ask my accountant whose mistake was this. My accountant said it was nobody's mistake. It was just a little miscalculation. Well, it was clearly a mistake that should have been caught earlier. So I paid that money and then I proceeded to fire my accountant, and then I found a new accountant, and then what I realized is a good accountant is going to do more than just file your taxes. They're going to do tax strategy. And what tax strategy is working with you to discuss your plans, to see what are the ways that you can lower your tax bill based off of what the IRS says today. Because the reality is, and I'm telling you this as a licensed attorney, the IRS gives a rule book called the tax code. In fact, I will show you. This is a copy of the federal income tax code. Yes, I keep a copy of this in the office, and it is more than 2,000 pages long. And what this tells you is not you just pay taxes on your income, is it tells you all the ways that you can qualify for deductions, all the ways that you can qualify for different tax breaks. And real estate has some of the biggest and best tax breaks that our tax code has to offer, but the only way you can take advantage of them is if you have a good accountant. Let me briefly show you what I mean. Let's assume that I own this property right here and it's making $10,000 a year in profit. This is after paying all of my expenses. Now, normally when you have this $10,000 of profit money that's sitting in your bank account, you have to pay taxes on all $10,000. Well, in real estate, that's not exactly how it works. The first thing that you get to do as a real estate investor is you get to qualify for something called depreciation. This is a paper write-off. It's a paper deduction. I call it a paper deduction because it's only on paper. It's only on a tax bill. And so what you get to tell the IRS is, hey, my property is 1 year older. Because my property is 1 year older, I deserve a tax break. And the tax break is going to depend on what the property's value is when you bought it. So let's assume that you get to take a $6,000 deduction, depreciation deduction. I'm not actually going through the numbers here. This is just a hypothetical. This means you get to tell the IRS, hey, I made $10,000 in profit, but I'm only going to pay you taxes on $4,000. This is what real estate investors are doing all the time as a way to make a lot of money in real estate, but paying little to no money in taxes. In fact, some people will take this one step further, which I'll explain in just a minute, but you get to take this depreciation deduction even if the value of this property goes up. So let's assume that I bought this property for $200,000. Now it's worth $300,000. On paper, I've made $100,000, although you don't actually make any money until you sell. Even if your property goes up in value, you get to take this write-off, this depreciation deduction, because you're telling the IRS, because my property is 1 year older, I deserve to get this write-off. It's 100% legal. The IRS allows you to do this. Now, when you get a little bit more advanced, you get a little bit more sophisticated, you can do something called accelerated depreciation, which says essentially, instead of me taking a $6,000 write-off in year one, I'm going to take a $20,000 write-off. I'm going to take more of this depreciation in the first year of my property. So instead of having a $10,000 profit, I actually have a $10,000 loss on paper. On paper, because, well, I have $10,000 in the bank, but I'm telling the IRS I have a $10,000 loss. Now, depending on what my income is from my job, I could potentially take this loss from my real estate and lower my tax bill from my job. Again, this is going to depend on how much money you have. If you're a high income earner, you're not going to qualify for this, but some people will be able to qualify for this. Or you could take this loss and carry it forward to the next year. But that's not all. The IRS can go even one layer deeper with real estate investors. If you bought this property for $200,000, then a few years later, if you sell it for $300,000, you have a $100,000 gain, which normally you'd have to pay taxes on. Well, with real estate, there's another loophole. It's called 1031, the 1031 exchange. And what it says is if you sell your property for a profit, assuming you held on to it for at least a year, you can take all this new money, you can take all $300,000, buy another rental property, and now you can defer paying all of those taxes. So instead of paying the taxes on the $100,000 of profit, you could take all $100,000 plus the additional $200,000. So you take all $300,000, buy a new rental property, and you don't have to worry about paying any money in taxes on that gain, and you can do this again and again and again until you die and never have to worry about paying a penny in capital gains taxes. It doesn't work like that in the stock market. If you bought a stock for $200,000, or let's call it $200, then you sold it for $300 2 years later, and then you bought a different stock for $300 with your profits, well, you still have to pay taxes on the $100 of profit that you got. With real estate, you can qualify for this 1031 exchange, but again, in order for any of this to work, you have to have a good accountant because there's a lot of nuances, there's a lot of moving parts, and if you do it wrong, well, you can get hit with big penalties, big fines, and potentially go to jail. So get yourself a good accountant who understands this and can help you lower your tax bill. And number 5 is get yourself a good real estate agent, a good real estate broker that can actually find you deals. And I'm saying this again from experience because what you don't want is a lazy real estate agent who just wants a commission for not doing any work. Now, when I started working with real estate agents, I went out and got my own real estate salesperson's license because I didn't like the agents that I was working with. But now, after doing real estate for a long time, I have found that there are some good real estate agents and some very lazy real estate agents. What a lazy real estate agent will do is they're gonna want you to sign an exclusive contract saying that they're gonna get paid no matter what. They're gonna get paid no matter who you buy the property from and no matter what property you buy, even if you buy the property yourself through a deal that you found. Absolutely not. What I want is if you find me a deal, I will pay you your commission gladly. But if you don't find me the deal and somebody else does, I'm not going to pay you your commission because I want to work with whoever is going to bring me the deal and I don't want to be exclusive to one broker. Now, what does that mean? I want to find brokers that will actually do the work in the industry that I'm looking to work in. So if I'm looking for single family houses to invest in, I want to find real estate agents that specialize in single-family rentals. If I want to invest in multifamily apartment complexes, I want to find a broker that specializes in that. If I want to invest in office buildings, I want to find brokers that specialize in that. But the key is, you want to find people that are good and they can actually bring deals to you that you might not see otherwise, because guess what? Zillow and Redfin are very powerful. You can go on there and see a ton of listings, which you can do that work yourself. What a good real estate broker will do is, number 1, they will find you deals that are off market, that are not publicly available. And number 2, they'll be very good negotiators and actually fight for what you are looking for, because you want somebody who's going to be on your side, not somebody who's just looking for a quick commission check. You want to make sure that you can make money in this deal for years or decades into the future, and it starts with finding a good property, and a good broker can help you find those good properties. But there's a difference between a good real estate broker and a lazy real estate broker. There's a difference between a good accountant and a lazy accountant. There's a difference between good contractors and bad contractors. There's a difference between good inspectors and bad inspectors, and there's a world of a difference between good property managers and bad property managers. This is why real estate is a team game. You have to build a strong team, and it's going to require you to find people, hire people, and fire them when they're not good. Now that you understand the location and how to build a good team, let's talk about how do you actually run the numbers as a real estate investor. The way you run the numbers in real estate is by following an analysis something like this. So you're going to buy this property for, let's call it $200,000, and you can rent it out for $2,000 a month. Well, all this $2,000 in rent is not going to be your profit because you have expenses to pay. What are your expenses? There are 5 main expenses you have to think about as a real estate investor. That is, number 1, your property taxes. Number 2, your insurance. Number 3, your maintenance. Number 4, your management fees. And remember, even if you don't have a property manager, you still want to factor in a management cost because you have to factor in your time as well. And then you have number 5, your vacancy cost, because the reality is your property is not going to be fully occupied 100% of the year. There will be times where tenants move out, so you want to factor that cost in there. Once you get this number, this is called your NOI, your net operating income. This is your profit, assuming that you have no mortgage. If you get a mortgage, you're going to subtract that number from your NOI to get your profit. But this is how you run your numbers, so let's do it. So if you rent this property out for $2,000 a month, let's assume your property taxes are $300 a month or $3,600 a year. Your insurance costs are roughly $150 a month. You have to pay maintenance costs of $200 a month. I put this as 10% of the gross rent. That way, even during the months you don't have a maintenance expense, you could put that $200 aside. That way you can cover bigger expenses when they happen. Management costs, I put at $200 a month, which again is 10% of the gross rent. You can sometimes find it even cheaper than that, but we're gonna go with the 10% number here. And then I added a 10% factor to vacancy as well. So I took 10% of this as $200. I like to be generous with my expenses because if I make more profit than I expected, well, I'm not gonna be upset. But if I make less profit than I expected, now I'm gonna be a little bit more angry. That's why I like to be a little bit more generous with my expenses. Now, when you add all these up, if I do my math correctly, it looks like it's gonna be $1,050 in my expenses. So my NOI, my net operating income every month is $950 a month. Now, if I take this number and multiply it by 12, this means that my annual income is $11,400 a year, assuming that I don't have a mortgage. We'll do the mortgage calculation in just a minute. But is this a good deal or a bad deal? Is this a good return or a bad return? And this is gonna depend on you. This is where you wanna take a look at your ROI, and in commercial real estate, it's called the cap rate. All this means is what is your cash on cash return, assuming that you bought this property all cash. So the way you calculate that is you take this NOI number, and you're gonna divide it by the cost of acquiring the property. In this case, it was $200,000, which means when I take $11,400 divided by $200,000, I get a little bit under 6%. It's actually 5.7%, which means it's a 5.7% cash on cash return on my money. I'm gonna put in $200,000 of cash, and I'm gonna get a 5.7% yield, dividend, profit, NOI, call it whatever you want, based off of a $200,000 investment. Is that good? Is that bad? It's gonna depend on you. For me, I like to look for a minimum of 7% cash on cash return, just because that's what I look for. Some of you might say 4% is good. Some people say 2% is good. Others will say I need a minimum of 10%. That's gonna depend based off of what your goals are, what your risk tolerance are, how involved you wanna be. But for me, I look for a 7% number. Now, if you have a mortgage on the property, you're just gonna follow the same analysis. Let's assume that you put 20% down, which in this case would be $40,000. That means you got a loan for $160,000. And now once you have this $11,400 of NOI, you have to then subtract the mortgage and see if you're still profitable. If you finance the other $160,000 at a 7% mortgage rate, well, now your monthly mortgage payment will be a little bit over $1,050 a month, which is more than your NOI, which means you're gonna lose about $100 a month owning this property with a mortgage at 7%. But if you were to put down 30%, well, now you are slightly positive, which means in order for this deal to actually make sense based off of a 7% mortgage rate, you're gonna have to be willing to put down at least 30% or get a cheaper price or were to increase the rent. That's the type of analysis you have to run, and then you have to find what is the right percentage return for you to actually justify you making the investment. For some people, it's gonna be higher, others will be lower. You have to find the right investment opportunities for you based on what your personal goals are. And now with that, you know how to find a good location, how to build a good real estate team, and how to analyze the numbers. And again, if you're looking for some more resources, my team at Briefs Media has a free newsletter, Market Briefs. And when you join, you'll also get our investing masterclass free as a bonus just for joining. And that link is for you down in the description. Being wealthy means your investments are making you enough money to pay your expenses, so you don't need a job to pay your bills. The problem is most people will say, just invest your money into the stock market. But what if you don't know what stocks to buy? Or what happens if the stock market crashes and now your portfolio gets cut in half and you were relying on that income to pay your bills? This is